Good day. Today we're going to be looking at IS 8 accounting policies, changes in accounting estimates, and errors. Then, as usual, we're going to be taking it bit by bit and we're going to be covering some areas which we would highlight first. And in the notes here, we have the first area we're going to be taking a look at, which is the definition. And the criteria for selecting and changing accounting policies. Now, this topic, IS 8, has three broad areas. The first is accounting policies, the second is accounting estimates. First policies, second estimates, then third errors. So, then the third aspect is the treatment and disclosure of the first of the three changes in accounting policies. The second is changes in accounting estimates. Then the third is changes, or rather correction of errors. So we have policies, estimates, and errors, and we'll be differentiating the three of them from the definition. Then we'll be looking at the treatments. So we'll go to the definitions now. And the first definition we have here is accounting policies, and it says accounting policies are specific principles, bases, conventions, rules, and practices applied by an entity is an organization, in preparing and presenting financial statements. Now, the policy, just like the word policy, it's what the financial statement is based on. The principles, we've listed it here: principles, basis, conventions, rules. The rules, yes, to make it a little bit easier, is rules that you prepare your accounting policies, or rather your financial statements on. Then we'll be looking at accounting estimates now, and it says, and the definition will give us a clear distinction between both of them. The second one, which is accounting estimates, it says accounting estimates is an approximation. Now that's the main difference. Approximation for accounting estimates, and we are not done yet, of amount to be debited or credited as amount to be posted on items for which no precise means of measurements are available. Now, in accounting estimate, like the word estimate, there's a little bit of, shall I say, uncertainty about its measurement. Yeah, uncertainty about its measurement. You can't pinpoint a definite figure for the item or for the transaction that occurred. Sometimes it might not be real transactions like an exchange of goods, trade, and the like, but we'll be having examples of them at the end of this class. It's down there. So now it says they are based on specialized knowledge and judgments derived from experience and training. Now the main part is the first part, is an approximation of amounts to be debited or credited on items for which no precise means of measurement are available. So we have accounting errors here, and it says an error is a non-fraudulent discrepancy in financial documentation, omissions, and misstatements in an entity's financial statements for one or more periods, arising from, first is failure to use, then if it's not failure to use, misuse of available reliable information. So now we have non-fraudulent discrepancy to note here, and it's arising from a failure to use or misuse of available reliable information. Now we could have human errors here, but since computers, machines, artificial intelligence has been introduced into accounting, and real-time reporting through computers, this aspect of errors has been reduced significantly. So rather, errors have evolved into maybe machine errors, they could occur, but now human errors are lesser in large corporations. Then and of course, error is not fraud. Fraud is deliberate, error is not deliberate. Then we have an accounting error is an error in accounting entry that was not intentional or not deliberate. A deliberate one is fraud. In an absence of IFRS guidance, it says management uses its judgment in developing and applying an accounting policy that results to information that is reliable and relevant. And it's trying to tell us that when there is no IFRS guidance on a particular treatment, the management is free to use its judgment in applying a policy. Now we made the definition of policy. We made the definition of policy here: specific principles, basis, conventions, rules, and practices applied by an entity in preparing and presenting its financial statement. So management is free to set the rule on which that particular transaction is following in recording it in your financial statement. If there's not a rule given by IFRS on that particular transaction, the management is free to set its own rule. But in setting its own rule, there are two conditions here. The information must be first reliable and secondly relevant. So we have those two conditions met, then it's free to put in the principle it wants in the financial statement for the transaction. So it says in making such decisions by management refers to through in making decisions that IFRS has not clearly given for a particular transaction. Obviously, we know there are new transactions emerging as ICT is developing, artificial intelligence is developing, even space research is developing. There are new things that were not thought about previously that could come, new types of transactions, new types of business agreements. So if it is not already taken care of by IFRS, the management is free to set its own principle, but the presentation must be reliable and relevant. The information must be reliable and relevant. Then in doing this, they could also refer to similar standards if they exist, and also they check the definition, recognition, measurement to classify it as either assets, liability, income, or expense, to classify the new transaction as an asset, liability, income, or expense, because that is where the bulk of transactions go into. So now it says changes in accounting policies. It says changes in accounting policies are applied retrospectively unless impracticable, or another IFRS standard gives a different operation. So we have policies applied retrospectively, and we would emphasize more on retrospectively as we go on with the class here. Then changes in accounting estimates now are applied prospectively unless impracticable, or another IFRS standard gives a different operation. Then the third aspect we have here is correction of errors are applied retrospectively unless impracticable. So we have correction of, I'll start from the first now. Accounting policies retrospectively, policy retrospective, PR, estimate prospective, EP, and errors retrospective, ER. So PR, EP, ER, just a short form for us to quickly get it during exams. Then we'll take a look at the term retrospective. So it says retrospective change for policies That is applying a new accounting policy to transactions, other events, and conditions as if that policy had always been applied. And in that way, it affects three areas: the present period, now we're in 2020, 2020, and if they are to present a financial year and you find out that okay, we want to change this policy that we've been using, we want to change this rule that we've been using for presenting this transaction, we'll change it for the year 2020. We said 2020, okay, we want to change this, we'll change it for 2020, which is the present or current period. We would also have to change it for past period. Now, by changing it for past period, we would adjust the opening balances of the previous years from the date when the transaction initially occurred. If it occurred first in probably 2005, so it starts from 2005, 2006, 2007, 2008 down till 2020. And if this date is not practicable, we start from the earliest practicable date. The earliest practicable date. If the earliest practicable date is 2010, you'll start from 2010. Start the changing from 2010 by changing their opening balances. Then we have the past periods here. Adjust opening balances of transactions affected for the earliest period the transaction occurred down to the current year, as 2020 here. Then the third and final is future. So we have past, present, future. If the transactions will occur later, so if it will occur 2021 financial statements will no longer take the old principle we used, so to take the new principle. Then prospective change is from now on. Retrospective is from the past down. Prospective is from now on. That's from the current on. Forget about the past. Just like forget your past. That's what prospective change is. So that's the current period, 2020, future periods, if they would occur. So we have material omissions, and we'll be learning under this subtopic here. And it says omissions are omissions or misstatements of items are material. Now we would want to learn how an omission is material. And it says if they could individually, if a transaction, let's say a purchase of an asset could individually or collectively influence economic decisions that users make on the basis of financial statements. I'll give an example. A purchase of probably an aircraft. The price is obviously huge. There's nobody who will purchase an aircraft that would say, okay, this price is not substantial in presenting, depending on the size of the company, it's not substantial for presentation. So since the price is huge, it could influence how potential investors would want to buy shares in that company, especially for companies companies that operate in the airline industry. If you buy a new aircraft, people, okay, it has a potential to generate revenue to our company, so we could invest in it. The money was not squandered or wasted, so that money is material. The price of an aircraft is material. Then it says it will influence the users make on the basis of financial statements, influence economic decisions that users make on the basis of financial statements. So materiality depends on size, on nature. Size, like the aircraft, the cost, the price is huge. Nature, the industry it operates in the aviation industry. So the nature, obviously, aviation industry, aircrafts, they are related. So the nature of the industry, aircrafts are related to, and the size, the cost of an aircraft is considerably huge. or both, which the aircraft fits into. So it says if there are no IFRS policies, then management can pick information. The first one is relevant to decision making of users, then reliable. For presentation, it must be relevant to the users, then reliable. Third, represents faithfully the financial position of the company. Now, the financial statement of financial position is obviously from the name to represent the financial positions, but companies can maneuver, or some companies maneuver their financial position records to make the company appear bigger, sometimes even lesser, to pay lesser taxes. So what it's saying is that when presenting and there's no IFRS guidance, obviously IFRS guidance is to guarantee fairness among all shareholders. So when there is no IFRS, rather than shareholders, stakeholders, because shareholders are under the category of stakeholders in a business. So rather than um okay, represents faithfully the financial position of the business. So it must be the exact financial capacity of the business as at that point. Then neutral, that's neutral to all stakeholders, not biased, favoring one and leaving the other. Prudent, complete in all material respects. That's complete. You don't leave material parts, and we've already given an example of materiality. You don't omit the aircraft for companies that operate in the aviation industry. Then reflects the economic substance of transactions rather than the legal form. Now, economic substance is okay, it's basically who gets the money, who gets the reward from using the asset. Legal form, I could be the owner, but I am not getting the economic benefit from that asset. I'm just the owner. So those are the two basic things. And rather than legal form, accounting uses the economic substance, who derives the economic benefit from the transaction as the owner in quotes. Then consistency must be applied for easy comparison. Then changes in accounting policy. Now consistency, you must be consistent to compare. You can't change this year, change next year, and you'd want to compare both of them. They were not prepared on the same basis. They were not prepared on the same, should I put it as in a layman's term, leveled ground. An example is changing, valuing my stock at hand. If I change it today, okay, it should be valued at so, and later the next year I change it, okay, it should be valued at this way. Both of them are not comparable because this valuation might present a higher figure than the other one, and comparing it won't be fair. Then also, that's why you must be consistent for comparison. Then also, changes in accounting policy if is permitted only if one, required by IFRS, two, results in the financial statement FS, providing reliable and more relevant financial information. An application of a non-accounting policy to a transaction that never occurred is not a change in accounting policy. You should note that a new accounting policy on a new accounting policy, new transaction is not a change because it's new. You're not changing from anything. Limitations to retrospective application: no adequate information is part of the limitation. Not impracticable when the amount cannot be determined, the date cannot be determined. Assumption about what management intent would have been at The past period, which I gave an example, is 2005, cannot be determined. It requires a significant amount of estimates that are impossible to distinguish. That's when it's a combination of different elements or different things in, and to distinguish it is very hard. Then it might be hard to apply a retrospective correction method. And if it is still impossible to adjust retrospectively, then use prospective correction. So if you can't correct past periods, then you do from now henceforth you forget your past. But you must first check if you can correct it, and if it's not possible, then you do the from now henceforth. So we have disclosures here, and we said disclosing notes the title of the standard IS-8, obviously, nature of change, what it affects, the reason of change, and obviously the amount. Now the amount should be posted on the book, not in the notes in the books. So we have example of accounting estimates here. So estimates are something not certain. From the estimate, not certain, there is a little bit of uncertainty about the figure. You can't pinpoint a particular value because, as I mentioned before, some of them are not real transactions. So now we'll be saying it here: bad debts. You can thoroughly estimate. Bad debt is an estimate. You are estimating, okay, this person might not pay. It's still a might, so you'd have to estimate it. Then inventory obsolescence valuation. Now that is also something you estimate. Like, okay, so part of my goods have been damaged. How much would they buy these damaged goods if I want to sell them? I'm estimating now they won't buy it at full price, obviously. So I would have to reduce the value of the goods, which I don't know how much the customer would buy it for. Fair value estimation, useful life. You estimate, okay, this machine, okay, it will last between 5 to 6 years. So you're estimating the life of the machine. Depreciation method, warranty provision, and it also says here when difficult to distinguish, put as estimate. Just that when difficult to distinguish between, or rather retrospective application is hard to enforce, you'd use prospective from now henceforth. So that brings us to the end of the class today. Hope you enjoyed it.